Hello and welcome to Module 7 of Navigating Nigerian Economic Realities and Challenges. In this module, we shall be looking at investment strategies in a volatile economy, that is protecting and growing wealth amid inflation, currency devaluation, and market uncertainty. Welcome. In a volatile economy, investing is not optional. It is essential for preventing wealth. Therefore, this model provides practical strategy to navigate risk, hedge against inflation, and build long-term financial security. The model content that we should be looking at here include basics of investing, that is risk and return, investment options in Nigeria such as stock, real estate, agriculture, etc. We'll also look at hedging against inflation and currency devaluation. We'll further look at diversification and portfolio management. We will further look at avoiding scams and unsafe investment schemes before we draw our conclusion. By way of introduction, why invest in a volatile economy? Titled Savings Alone is Not Enough. Inflation continuously erodes the purchasing power of idle cash. Example, if inflation is 25%, money left in a savings account loses value every month. Therefore, investing helps you to grow wealth faster than inflation, generate passive income, and achieve long-term financial goals, especially retirement, education, and access. The key message here is that in a volatile economy, you must make your money work as hard as you do. Note, savings preserve money temporarily, but investing grows it. With inflation, you lose money by doing nothing. Having known that, let us look at understanding risk and return, titled The Foundation of All Investment Decisions. Risk is equals to possibility of losing money or not achieving expected return. Then return, on the other hand, is equals to profit, income, or financial gain from an investment. The correlationship between them is that higher risk is tantamount to higher potential return. Then lower risk result to lower potential return. Now we have different types of risk. Some of them include market risk, which include price fluctuation. We have inflation risk, which includes purchasing power loss. Then we have currency risk, that is exchange rate fluctuation. Then we have liquidity risk, which cannot convert cash quickly. Now note that there is no reward without risk. Therefore, the goal is to understand risk you are taking and ensure the potential return justifies it. Let us look at risk tolerance, that is know yourself, titled Invest According to Your Capacity, Not Your Emotion. Risk tolerance is the ability and willingness to accept potential loss. Now we have three investors profile. We have number one, conservative investors that prefer safety, accept low return. So conservative profile always prefer that they are safe and they always accept low return. Example, treasury bill and fixed deposit account. Now we have moderate profile. This one balances safety and growth. They accept some fluctuation. Example, like government bond, mutual fund, and real estate. Then we have aggressive profile. This one seek higher return and accept high volatility and potential losses. Example include those that deal in stocks, startup capital, and cryptocurrencies. Now, factors that affecting risk tolerance include age, income, financial goal, time horizon, and dependent. Please note that do not copy another person's investment style. What works for a young single entrepreneur may be disastrous for a retiree. Therefore, know your profile. Having known that, let us now look at investment option in Nigeria, the overview. That titled Where Can You Put Your Money? Now we have different types of investment option in Nigeria. Number one is you can invest in a stock, that is ownership in companies, potential for dividend and capital appreciation. We have real estate, which include land, houses, rental properties, inflation hedges, and long-term growth. We have investment options like agriculture, which include farming, processing, livestock, that is characterized by high demand and government support. And we have fixed deposit and treasury bill, which is characterized by low risk and guaranteed, but it results to lower return. And we also have mutual fund, which is professionally managed and diversified portfolio. Then we have small and medium enterprises where you can invest your money. That is direct business investment. It is characterized by high potential but active involvement. You must be actively involved in the management of the business. Now we have digital assets, which include online business, technology startup, and cryptocurrency that is characterized by high risk. Note that each option has different risks, return, liquidity, and capital requirement. Therefore, no single option is best for everyone. Let us now look at matching investment to your goals, titled Short-Term versus Long-Term Thinking. Now, we have short-term goal, which ranges between 1 to 3 years. This type of goal needs liquidity and capital preservation, and a suitable option include fixed deposit, treasury bill, and money market fund. Now, we have medium-term goal that ranges between 3 years to 7 years. This one balance growth and safety, and suitable options include mutual fund, real estate with planning, and agriculture. Then we have long-term goal that is usually above 7 years. This one can tolerate volatility for higher return, and suitable options include stock exchange, land banking, business equity, and retirement portfolio. Please note that match your investment time horizon to the asset class. Putting short-term money into a volatile stock is gambling, not investment. Now let us look at hedging against inflation. That is, protect your purchasing power. Inflation is the same thing as money, buy less over time. So inflation is when money buy less items over a period of time. That is, your 1 million naira today may buy only 700,000 worth of goods next year. Assets that hedge against inflation include, when you invest your money in real estate, you are hedging against inflation. That is, property values and rent rises with inflation. So when you stock your money in real estate, you are hedging against inflation. Another area of hedging is stock, that is selected sectors. When you buy stock like in banking, consumer goods, telecoms often pass cost to consumers. So stocks is another hedge for inflation. Then agriculture, that is food demand is inelastic. Therefore, price of agriculture rises with inflation. Another hedge is precious metals such as gold. Gold historically hold value during inflationary periods. Another hedge is business ownership. You can adjust price to match rising cost. So when you establish a business, you can adjust your price in order to match the inflation that is prevalent in the economy. Note that the worst thing to hold during inflation is physical cash. Convert your cash into an asset that appreciates or generate income that rises with the price increase. Now let us look at the hedging against currency devaluation, what you can do when the currency becomes to devaluate. That is protecting against Naira's weakness. Currency devaluation is equals to Naira loses value relatively to foreign currency like US dollar, euro, and Great Britain pounds. The effect is that imported goods become expensive, foreign school fees increases, travels and medical costs rises. Then hedging strategies include hold stable foreign currencies like US dollar or euro legally and within certain limits. Invest in export-oriented business that will help you to earn revenue in foreign currency. Then consider dollar-dominated assets where available and legitimate. Then finally, diversify internationally, explore foreign mutual fund or ETF with professional guidance. Caution, do not fall for illegal dollar investment scam. Use a regulated channel. Note, you cannot stop currency devaluation, but you can reduce your exposure. Therefore, earning or holding asset in stronger currency is a legitimate hedge when done legally. Having known that, let us now look at the diversification. That is, don't put all egg in one basket. The most important risk management tool is diversification. Diversification is equals to spreading investment across different assets, sector, and even geographies. Why it works is because different investments perform differently under the same economic condition. Example, when stock falls, bond or real estate may hold steady. Then when naira devaluate, export earning may rise. Examples of diversified portfolio include 30% of your income in real estate, 25% in stock, 20 in agriculture, 15 in treasury bill, and 10 in small and medium scale enterprises or business investment. Note, diversification does not eliminate risk, but it reduces the impact of any single investment failing. Therefore, spread wisely, not randomly. Now let us look at portfolio management, that is, organize your investment, titled Investing is not one-time event. Portfolio management is equals to selecting, monitoring, and adjusting investment over the time. We have three types of portfolio. Like we said earlier, conservative, which is very low risk and stable return. Then we have balance, which mix of low and moderate risk. Then we have aggressive, that is characterized by high risk for high return potentials. Now, the key management principle include rebalance periodically, that is sell winner that have become too large percentage. Now, we have another principle which involve review performance quarterly, not daily. Avoid emotional decision. Then lastly, adjust as goal or economic condition changes. Note, set your portfolio, then manage it. Do not abandon it, but also do not tinker with it every time the market switches. Now let us look at avoiding scam. That is the red flag, how you can avoid investment scam, titled If It Sounds Too Good to Be True, it is. It is not. Then common scam characteristics, unrealistic return. So whenever investment return is not realistic, know that it is a scam. That is 50% profit in 1 week. This is unrealistic return. Then guaranteed profit. Whenever an investment is guaranteed particular profit, know that it is a scam. No legitimate investment guarantees return. Then when there is a pressure to invest quickly, that is limited offer or act now, it is a red flag. Therefore, you must run away. Then when there is no proper registration like Corporate Affairs Commission, CAC registration or SEC, Security Exchange Commission, is not well, when the business is not well registered with this organization, it is a red flag. Then if it is based on referral earning like Ponzi and pyramid scheme, that is bring one person and earn this, it is a red flag. This investment is a scam. Example in Nigeria include fake online investment platform like Forex, cryptocurrency, and digital trading. These are examples of fake investment. Then fraudulent cooperative savings scheme is another example of fake investment. Then lastly, wonder banks and unlicensed fund managers is also an example of fake investment platform. Note, greed is the scammer's best friend. If an opportunity promises return far above what reputable banks or investment can offer, it is a red flag. Therefore, walk away. Having known that, let us look at how to verify legitimate investment. Do your homework before you commit. Now, the following areas should be well investigated. Check registration. Check whether the business is registered with Corporate Affairs Commission. Check whether the investment or the security investment is registered with Security and Exchange Commission. That is the investment scheme. Then for banking, check whether it is registered with Central Bank of Nigeria before you can bank with them. Then another area is verify the business model. How does the company actually makes money? Is the model clear and understandable? Then research the management team who is running the investment, and do they have a verifiable track record? Then seek independent advice, like consult financial advisor, experienced investor, and trusted professional. Start small. Test with a small amount before committing significant capital. Therefore, if you must start with small amount before you commit a significant capital. Note, legitimate investment welcome your questions. Scammers avoid scrutiny. Therefore, verify before you trust. Having known that, let us look at self-investment practice. Discipline beats desperation. Self-investment practice include invest only what you can afford to lose. Therefore, another strategy is diversify across asset classes. Use licensed financial institutions, then keep a proper record. Monitor your investment regularly. Never invest based on pressure, fear, or FOMO, that's the fear of missing out. Finally, improve your financial literacy. That is, knowledge is your best friend. Note, patience, discipline, and education are the three pillars of self-investing. Desperation leads to bad decisions. In conclusion, strategic investing in volatile times. Risk is real, but so are opportunities. Volatility is not a reason to avoid investing. It is a reason to invest strategically. The key takeaway here is that understand risk and their return, know your risk tolerance and invest accordingly, explore Nigeria's diverse investment options, hedge against inflation with real assets, hedge against currency devaluation through diversification and legitimate foreign currency exposure. Diversify across sector and asset classes. Manage your portfolio actively and avoid scam through verification, research, and financial literacy. The final message here is that in a volatile economy, the biggest risk is taking no risk at all. Therefore, invest wisely, stay disciplined, and build your financial future. Thank you. Remember, inflation and devaluation are not waiting for you to be ready. Therefore, start small, start smart, but start today. Have a nice day.